It is more unaffordable today than it has been at any point in the last 50 plus years. So what goes? House prices are rising, nearly 1 percentage point each month over the past 6 to 12 months. Sydney house prices are about to hit a new peak this year or early next. Auction clearance rates are near 70% every week, even with higher supply levels during the spring season. It is no longer a seasonal boom. You can't call it that when house prices have risen this much, this quickly in 2023. This is despite interest rates rising by over a percentage point in 2023 alone. It's now spitting out big red crosses. The financial metrics assessing the Sydney housing market are concerning. In this video, I'm going to unpack those metrics and show you how Sydney and borrowing capacities do correlate over time and answer, is the link now broken? I'm also going to go through the rent or buy equation. This is one of my main tests to use to work out whether Sydney is showing value or not. Simply, when Sydneysiders get to choose to either rent or buy, and one of those metrics is showcasing an obvious green light, then the other doesn't do well. For example, there have been times in history where Sydney buying has been cheaper than renting. We saw that in 2020 when interest rates hit zero, and in turn, Sydney property prices rose substantially. We're now in the opposite period, where Sydney house prices are so high that it's significantly cheaper to rent than to buy. Hi, I'm Reedham Syed, founder of Confidence Finance, ex-Treasury economist, and avid property investor. I live in Sydney, so this video is a little bit painful to make. But my team at Confidence Finance helps thousands of investors and homeowners grow, scale, and build their investment portfolios. On this channel, I talk about property, lending, and the housing market. So if you're interested, hit that subscribe button, give this video a like, and help support me on my journey to create content. So let's get into it. The first metric: borrowing capacity and financing ability to buy a median home in Sydney. Now, this problem is actually not only a Sydney problem. It exists all across the country, but it's mainly focused in Sydney as our most expensive capital. Melbourne, Brisbane, Adelaide even has similar problems with unaffordability at the moment. If you look at this chart, you can see a clear link between house prices and financing capacity. As one can borrow more, house prices rise as a result. But if you look at what's happened in 2023, this link looks broken. The ability to finance has come down dramatically. We're seeing that day in, day out when we model out borrowing capacities for property investors and homeowners and see a 20, 30, even 40% reduction inside the last 18 months alone. Borrowing capacities are driven by interest rates and, more importantly, the assessment rate that banks take, or the assumed interest rate that a bank uses when assessing how much to lend to you. As interest rates rise, borrowing capacities fall. You see that in this chart. But what's happened in 2023 is, on the back of migration demand, strong rental income growth, low vacancy rates, and a whole range of push factors that are creating underlying housing demand without corresponding supply increases, house prices have actually risen despite people being able to borrow less. We saw the initial impact of these rate changes in 2022 when Sydney house prices had one of its largest ever falls in 40 years. But now we've had house prices rise almost back to their peak level, with borrowing capacities still remaining at their lowest point. When you have this obvious spread that you can see. Going a little bit further, you can track this over time and show a correlation between borrowing capacities and house price growth. Look at this chart on the left here, and you can see how over this 20-year plus period, since 1994, there's been a very clear relationship. That is now broken, particularly in Sydney, where house prices have been rising, yet borrowing capacities fall. Will this last, or will we revert back to that 30-year history? The answer is we don't actually know. But at this level, that unknown is betting against history. And when you do that, it's a little bit riskier as a result. On the right-hand side, we have the affordability of each state. When you look at Sydney, it goes way out there, where nearly half of a new purchaser's income is going to mortgage payments at the moment. This is a function of high interest rates relative to the debt size And when you take a look at it, it doesn't look pretty. It's all across the board as well. Almost in every state, you have a higher home loan repayment to income ratio than ever before. Perth does exhibit some potential for growth here because in the mid-2000s, during the mining boom, it did approach that 40% level, while now it's at that 30% level. 2, let's look at the rent or buy spread and how it's currently showing big red crosses for Sydney. Sydneysiders have a choice. You can either rent your home, or if you can buy your home. The decision to do so is often based on numbers. What do the numbers suggest? This is what this spread measures. When the spread is really high, it means that it costs significantly more to own your home than to rent your home. When the spread is 0, you can either rent or buy, and it'll cost exactly the same. If there's a negative spread, which rarely ever happens in Sydney, it means that it's actually more expensive to rent your home than buy. When that happens, typically house prices rise, and often house prices rise dramatically when this occurs. I recall seeing this scenario in 2020 when one of our clients bought a house as an investment with a granny flat in it in Western Sydney. It was for roughly $1 million at the time, and it was yielding a little over 6%, or around there. The interest rate on the loan was early 2%. What happened with this customer is they had $1 million owner-occupier mortgage, and they bought $1 million investment property in 2020. The numbers at the time were so good in terms of renting or buying that spread that when they bought this as their investment property and it had a 6% yield, that investment property, the positive cash flow from one Sydney property investment, paid for their entire owner-occupier mortgage interest cost. That's pretty ridiculous. You can pay for your own mortgage by simply buying one investment property. We are miles from that equation at the moment. In fact, if you go and buy a high-yielding Sydney property investment at the moment, you're going to find that that property is taking money out of your pocket instead of putting money into it. That's for a very high-yielding property investment in Sydney. For the average property investment in Sydney, it's taking a lot of money out of your pocket at the moment because interest rates for investors is approaching 7%, 6.5% interest-only loans, approaching 7% with further rate rises on the horizon, and yields are around 3%. That combination means you have quite the gap to make up, and each property investment is costing Sydneysiders a lot of money. Now let's look at history and take a look at this rent or buy chart. So if you go back in time, I'm not going to go all the way back to 1989. It was before I was born. I can barely tell what happened then. But let's go from 2003. If you look at the 2003 to 2008 period, what you had was a very high spread. That means it costs a lot more to buy your own home than to rent a home back in this period. Interestingly, when you correlate that with Sydney house price growth during that period, you have a period where house prices didn't grow at all in Sydney. If anything, they may have went backwards a little bit between 2003 and 2008. So this is showing a correlation. The last time Sydney house prices didn't rise for an extended period of time was when this rent or buy spread was really, really high. What happened after that little period during the GFC, interest rates fell. They cut rates multiple times, even 1% in one RBA board meeting, and that completely altered the dynamics here. And you had the rent or buy equation go back down to 0. This is really driven by interest rates because that's the variable that changes a lot. And when you go from high rates to low rates, you can easily make it cheaper to buy a home than to rent a home. So that's what happened in around 2008 during the GFC period and what happened as a result. That's when house prices, a year or so later after the panic of the GFC, house prices began to rise again. Can't really see it so clearly on this chart, but you can see an upward momentum kick in around that 2009, 2010 period, roughly a year after that spread became negative. Now, if you take a look back, we then went through another period where interest rates started climbing again. This was the 2011, 2012, 2013 interest rate increase period. I think it was roughly that period where the economy was doing fairly well. We came out of the GFC, recovered fairly well. Interest rates began climbing again. And you can kind of see it again. The spread between owning and renting became high again. Not quite as high as it is now, but it did approach a level above this 5 index that they've got here. And as a result, you can see Sydney house prices once again, voila, went backwards. Didn't rise, didn't fall very much, but barely went anywhere and went backwards for a period here. Now, taking a look at it from 2013 all the way to 2021, 2022, we're going through a golden little generation, interest rates down to zero all across the global world, and you have a setting where the spread between owning and renting came down and even went negative for a little period in 2019. That's when Sydney house prices shot up, and you could see this big step level change from 2013 onwards for the decade ahead. Between 2013 all the way to 2022, house prices had an upward trajectory. Of course, there were little moments where that was punctured, particularly in 2018 when the Royal Commission came out, a little bit in 2017 from memory as well, when the interest-only caps got hit. There were little punctuated periods through that, but broadly, there was this huge increase in house prices associated with this rent or buy spread. So many Sydney-siders all across the city did their numbers and worked out it's actually cheaper to buy a home than rent a home, or it's very comparable, like for like. And when it's that way, you'd probably rather own, given capital growth rates, tax concessions, etc., stability versus renting. That's a big driver that you have. But if you look at it now, and this is where you have the big red signal, the biggest red signal so far, the financial metric that matters. The rent or buy spread has hit its highest level ever. That means it costs more to buy a home than rent a home in Sydney, and that spread is bigger than it's ever been at any point since 1980, which is what this chart goes back down to. When you have that situation and house prices continue to be this high and rising, it's a little bit scary to go invest in Sydney. So the point of this video isn't to dissuade you and scare you off Sydney altogether. It's a city of 5 million plus people, 8 million in Greater Sydney. People want to live here, and that creates a lot of housing demand. And you may want to live here, and you may want to purchase your own PPR. But as an investment destination, it is riskier than other capitals. It is worth noting that other capitals also have this risk element to a lower degree, except maybe Perth. We saw that in the other chart here that showcases affordability rates all across the country. Affordability rates have been really, really poor, but in Sydney, they've hit that point where there's no longer capacity for Sydney-siders to continue to pay increased rates, which should mean a period of lower capital growth from 2024, 2025, and onwards, until there's a period of catch-up that helps normalize this equation a little bit. There'll be a few things that do help. Tax cuts will help. Further rental price growth will help. Any interest rate cuts that do happen over time will definitely help. And that's more than likely how this will normalize over the period ahead. It'll just take a little bit of time for that bubble to calm down. And for that to happen, you need Sydney house prices to stop growing at the rate that they grew in 2023. Nonetheless, there are opportunities in Sydney. I should reiterate that fact. Sydney is the city where house prices and land values are the highest value, and it's also a city where population growth is really, really high. We have a government with a very clear agenda: build up, not go out, and instead increase the density of land that exists within inner Sydney and in regions of Sydney where there's already existing dwellings. Build up, build increased density. That can improve the productivity of that land and create what I call alpha returns. So this will be very specific investment opportunities where the value of those land assets that you purchase rise over time, because instead of putting one house on it, you may be able to put 2 houses on it. And if you can currently put 2 houses on it, maybe you could put 10 houses on it. And if you're extra lucky, perhaps you sit on a plot of land that's quite chunky that could be turned into apartments over a period of time. And Sydney is the city where apartment values are highest, which creates a spread between the cost of building and the value of an apartment, which is where the land value appreciates as a result. So there you have it. There's my assessment of the Sydney property market and why it is clearly in the red zone. Something to be aware of for your investing future.